On today's episode, we are going to take a look at Sea Limited. They just reported earnings, so today I'm going to take a look at 3 things that I liked and 3 things that I wasn't a fan of. So let's get started. Alright, so for those that are not familiar with Sea, let's do a very quick recap. Right now, Sea Limited is traded under the New York Stock Exchange as ticker SE, is currently sitting at $223 as I am recording this episode, and it is up 2%, 2.11% after reporting earnings. If you guys were watching the live stream though, the stock was down about 5% when it opened up. So we can see from its low of the day, the stock is up almost 9.3%. So it has been a crazy turnaround, especially for growth stocks. If we take a look at the 52-week high, the stock is down a nice amount. It is down about 20% from there, and it currently has a market cap of $116 billion. For those that don't know Sea or the markets it hits 3 main markets, but most of its revenue comes from 2. First is digital entertainment, that it's gaming, it's esport markets. The second is Shopee, it's e-commerce market. And finally, they are also in the fintech service with Sea Money, but this one makes such small revenue for the company overall. Right now, the 2 driving forces are the digital entertainment and the e-commerce. All right, so now the first thing I really enjoyed about Sea was the overall revenue growth. 147% year-over-year growth in total GAAP revenue, and we can see most of it is coming from the 2 segments that I mentioned earlier, the DE, which is their digital entertainment GAAP revenue, and their EC, which is their e-commerce revenue. Those are up big. We can see year to year digital entertainment bookings is up 117%, and we have the e-commerce revenue is up 250%. This is still driving a huge force. We're also seeing a nice growth in the fintech service. It's about $50 million now compared to 10 million a year ago, so that's about a 500% growth, but still, it's still such a small segment of the company. The other thing is we can see, right, both these segments not only saw year-to-year revenue growth, but they also saw quarter-to-quarter revenue growth. So seeing both year-to-year and quarter-to-quarter is definitely a strong bull thesis in my opinion. And before we take a look at the second thing, make sure to hit the subscribe button and thumbs up, guys, if I'm providing some form of value to you. I truly appreciate it, and it helps so much with the channel. Also, let me know in the comments, are you bullish or bearish on Sea right now? All right, so the second thing I enjoyed about Sea's earnings is the overall growth in the platform, right? Not just the revenue growth, but the overall platform growth. Here we can see in digital entertainment, they saw a 61% growth in quarterly active users and 124% growth in quarterly paying users. I think this is pretty impressive, especially since their growth is also not only year to year, but compared to last quarter. That growth is also being seen in the e-commerce world. We're seeing here, right? Gross orders have increased 153%. Again, year-to-year growth, quarter to growth. And the gross merchandise value has also increased 103% compared to the same time last year, and it is still up quarter to quarter. So this non-stop growth Sea is seeing. And finally, in the fintech, even though it's a small portion, you can see that total payment volumes in quarter 1 is up over 200% compared to the same time last year. Quarterly paying users in their fintech services up 145% compared to the same time last year. All right, so the third thing I really enjoyed about this earnings was the improvement of their adjusted EBITDA. We can see same time last year, they were at a loss, where now they're sitting at about $88.1 million right now of profitability in adjusted EBITDA. And one thing I always try to find, like, the bearish thesis and stuff, right? For those that don't know, Sea Limited is a tier 1 stock in my portfolio. So it holds a huge portion of my portfolio. It's somewhere around 7 to 8% right now. Maybe after the gains, it might be a little bit higher. So I have to be very diligent on what's happening. So I wanted to see how this non-GAAP EBITDA or adjusted EBITDA compare to last quarter. Last quarter, they were actually $48.7 million positive in adjusted EBITDA. So again, we're seeing that year-to-year growth and that quarter-to-quarter growth, which to me is really giving me more excitement about the company. All right, so it can't be all good, right, for Sea. There has to be some form of negativity, right? A company is never perfect. And just because there is negativity, it doesn't mean I'm gonna sell. It just means these are things I'm gonna keep an eye out for the future quarters. It might be like, instead of not a true red flag, it might be a yellow flag where it's like, okay, be cautious of this within the next few quarters. And here are 3 things I want to be cautious about. But before I take a look at the 3 things I did not like, let's listen to today's sponsor. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You guys know I love finding new investing tools and resources to help me scout out new growth stocks. And right now I have a discount for one of my favorite services the Fool offers. Through the Motley Fool Stock Advisor services, you get access to a ton of expert stock picks. Every month you'll get 2 new picks that are aimed at growing your wealth and to help you realize your financial goals. Stock Advisor's average stock picks have done amazing returns. If growing your money is something you'd like to do more of this year, you can visit fool.com/Jose Najarro or click on the link below for access to my special offer and decide if the Stock Advisor is right for you. Thanks again to the Motley Fool, and now onto today's video. Alright, so the first yellow flag I want to talk about is actually one of the green flags I talked about earlier in this episode, and when I was talking about that revenue growth. So even though we saw revenue growth quarter over quarter and year over year, one of the yellow flags that I'm gonna say is that growth looks like it might be slowing down a bit. So who knows, maybe in the next few quarters we might see a flat line, we might see maybe a small decline in certain markets. So that's something I want to keep an eye on, right? Because year to year we saw 117% growth, but if we take a look at quarter to quarter, I think that's about a 10% growth in digital entertainment, probably about the same type of growth in e-commerce, right? So quarter to quarter, we're still seeing growth, but it seems to be slowing down and something we should keep an eye on. That's the first. And again, this is to me a yellow flag, not a true red flag, because it's not flat yet and there hasn't been a decline. If we see flatness or a decline, that might move to a red flag. The second flag I want to take a look at is the overall expenses this company is seeing. Revenue is increasing, but expenses are increasing at similar levels, right? For example, quarter 1 of last year, they had about $508 million in revenue expense, where now they had about $1.1 billion. So over 100% increase in cost of revenue. So I mean, you're seeing similar type of growth in your revenue compared to your cost of revenue as well. Another yellow flag here, and I do believe that's something certain investors weren't too excited about. So for the upcoming quarters, I am just going to be making sure that these expenses aren't increasing dramatically over time. All right, so the third thing I did not like about their earnings kind of trickles down from the second thing, which was the overall expense growth. This is going to be the net loss. Net loss continues to go down, right? We can see compared to same time last year, they had a loss of about $239 million, where this quarter they had $320 million loss, and this is excluding share-based compensation. But one green flag here is this type of loss is better than the one they saw last quarter, which also had less revenue and also had less adjusted EBITDA profitability. So some yellow flags, some green flags. Again, all these were yellow flags, not things I completely hate, but as a long-term investor, they are things I'm gonna keep an eye out. So now my overall thoughts on the company. What am I going to do after these earnings? After these earnings, I have no intentions of selling. C is already at a great position in my portfolio. So me adding on might have to take some crazy corrections for me to add on over time. If I didn't have a position in C right now, how would I play it? I would just do dollar cost averaging, add up over time. Right now the stock has pulled up a nice amount right from its $200 lows. So right now I would enter with either a small to medium position, and again, just build that position over time. Sometimes I might buy low, sometimes I might buy low, but that's the power of dollar cost averaging. So I hope you guys enjoyed today's episode. Take care and see you next time.